Assalamualaikum and good day to Sir Rizal and my fellow friends. We are from Group 3 and we present about capital structure and dividend policy of Aeon Co. M. Berhad. And our group consists of 5 members.
Definition. The first one is capital structure. Capital structure refers to the mix of equity and debt a company used to finance its asset. It is a critical financial decision that affects the company's risk, cost of capital, and overall value. An optimal capital structure balances risk and return for shareholders, minimize capital costs, and maximize the firm's value. The second one is dividend policy. Dividend policies are the rules a company follows to distribute dividends, influenced by factors like profitability, growth prospect, and economic condition. These policies, such as constant or residual dividends, reflect the company's financial strategy and aim to return value to shareholders. Next, advantages for capital structure is minimizes costs, improve profitability, enhance market opportunities, attract investors, and boost the company's valuation, leading to long-term growth and stability. For dividend policy, attract investor, build trust with stable returns, encourage loyalty, offer tax benefit, and boost shareholder satisfaction and strengthening the company's position. For disadvantages, capital structure is increased financial risk during downturn, lead to investor, limit operational flexibility, and make balancing debt and equity challenging for management. For dividend policy, limit reinvestment for growth, cause cash flow issue, lead to negative market reaction if change, and attract a narrow investor base, increasing share price volatility.
Hi, I'm Ridwana binti Ruslan. Today I will be presenting the introduction of our report. So, capital structure and dividend policy are vital to a company's financial health. This report is a means Eon 2023 financial strategy focusing on its debt to equity ratio and dividend policy. Eon balanced risk, growth, and shareholder expectation by aligning reinvestments with financial goals. Key factors include profitability, cash flow, and external influences like economic condition. This analysis provides insights into Eon's approach to managing capital, distributing dividends, and also achieving sustainable growth. Moving on to methodology, this report evaluates Aeon 2023 capital structure and dividend policy using both qualitative and quantitative methods. It analyzed financial metrics like debt equity ratio, ROE, and cash flow, comparing Aeon's performance with industry benchmarks. Qualitative analysis reviews performance reports and strategies, considering external factors like economic condition and regulation. This approach offers a comprehensive view of Aeon's financial decision and strategic alignment with market challenges. So for Aeon Company overview, Aeon Co. Berhad established in 1984 is a top Malaysian retailer known for its stores and malls. In 2023, it earned over 4.1 billion ringgit by focusing on customer value, quality, and also innovation. Beyond retail, Aeon manage malls as community hubs and supports sustainability with solar power, eco-friendly products, and also SME empowerment. Its CSR efforts in education, the environment, and disaster relief boost its reputation. Aeon's strong strategy and commitment to quality and community make them as a prime example in Malaysia retail sector.
Now, I will explain about the analysis of capital structure. The ratio that included is debt to equity ratio, and for annual bigger 1.81. It means the debt to equity ratio of 1.81 implies that annual finance 181% of its equity through debt. Next is analysis of dividend policy. The ratio that include dividend payout ratio, dividend yield, and return on equity. For dividend payout ratio, we got 49%. So the 49% shows that Aeon distribute its net income as dividend while retaining in growth opportunity. For dividend yield, Aeon got 0.49%. The 0.49% reflects the return investor receive through dividends relative to the share price. The last one is return on equity. Aeon got 6.80%. The 6.80% indicates that Aon generate return of 6.18% for every 1 ringgit of shareholders' equity.
So, we move to findings. For the capital structure decision, first, financial strategy and objective. Aon's financial strategy is rooted in a long-term vision to balance growth and stability. The company aims to maximize shareholder. This involves a careful analysis of both equity and debt financing. Second, debt management. The company monitors its debt to equity to ensure it does not become over-leveraged. By using prudent debt management strategies, the debt to equity ratio of 1.81 implies that Aon financed 181% of its equity through debt. Third, investment in asset. Aon prioritizing physical assets to enhance customer experience. And lastly, financial instrument. The company used various financial instruments to optimize its capital structure such as equity, loans, and bonds. Here, I include the pie chart illustration Aon's debt to equity ratio. For the dividend policy decision, first, commitment to sustainable dividend. Aon aims to pay dividends that are manageable in relation to its earnings and cash flow to return enough capital for reinvestment in business operation while rewarding shareholders. The return of equity of 6.18% indicates that Aon generates a return of 6.18% for every RM1 of shareholders' equity. Second, regular review and assessment. Aon conduct regular reviews of its dividend policy in light of its financial performance, market condition, and growth opportunities. This dynamic approach to adjust dividends payouts based on current financial health and future prospects. The dividend payout ratio is 49%. That communication with stakeholders. Aon emphasizing transparency in financial performance and dividend decision. Here I include the bar chart comparing Aon's return on equity. For the optimizing practice, first, cost management initiative. Aon uses various strategies for operational efficiency such as supply chain and reducing waste, so the impact is higher profit margin. Second, technology and innovation. Aon invests in data analytics and e-commerce platform, so the impact is enhanced customer experience. Third, sustainability practice. Aon implements environmentally friendly practice such as reducing plastic usage, so the impact is cost saving and improve company image. Lastly, continuous improvement. Aon regularly benchmark against industry standards, so the impact is adaptation to market trends. For the factors influencing capital structure, first, market conditions such as fluctuation in interest rates and the economy is in a recession or expansion phase. Second, operational need and growth strategies. Aon financing expansion plans based on growth projection. Third, cost of capital. If equity financing become too costly due to market conditions, Aon might increase its debt level to capitalize on lower interest rates, thereby optimizing its capital structure. Lastly, regulatory investment. Aon must compliance with governance standards impacting financial strategies. For the impact of recent economic conditions, first, post-pandemic recovery. Aon increased online shopping and the need for enhanced customer experience. Second, inflationary pressures. Aon adjusting capital structure to maintain liquidity and avoid over-leverage. Third, technological investment. Aon might opt for debt financing. For the example of companies adjusting capital structure, first, Delta Airlines. Delta Airlines use debt and equity mix for liquidity and the outcome is Delta Airlines survive demand drop. Second, Walmart. Walmart increased debt for e-commerce and the outcome is strengthened digital preference.
Next is how dividend policies are decided. First, close inspection of profitability and financial performance, where the company examines overall financial health closely. The more predictable and consistent the profit, the more likely it is to maintain regular dividend payout. Second is consideration of shareholder expectation. A company may prioritize dividend payment over reinvestment if regular income through dividend is expected by shareholders. Third is industry norms, where stable dividend stream is expected to grow or maintain as compared to competitors to ensure investors' confidence. Last is economic environment. During the economic downturn, a more conservative dividend policy is adopted to conserve cash. Factors considered when determining how much to pay out shareholders. First is leverage. The ability to meet both short and long term debt influence the ability to pay dividends. Higher leverage causes lower dividend payout as a significant amount will be allocated for debt repayment. Second is company's profitability. Dividend distribution depends heavily on the ability to generate profit, as part of the profit will be distributed as dividends. Strong profitability results in higher funds allocated for shareholders. Third is company's liquidity level. High liquidity ratio shows the ability to meet current liability with current asset. Healthy level of liquidity results in greater level of dividend payouts. Next is growth in net asset. If company chooses to expand, earning will be retained for future project rather than paying them out as dividends. Examples of companies that recently changed dividend policy. First company is Harley Davidson, where the change is reducing dividend per share from 38 cents to 2 cents. The decision driver is the extraordinary declining economic and market during COVID-19 pandemic. Second is SMS Co Ltd, where the change is setting the target payout ratio of 30%. The decision driver is achievement of financial soundness post-acquisition. Last company is AT&T, where the change is cutting annual dividend from uh, $2.08 to $1.11. The decision driver is the need to reduce debt due to unsuccessful large acquisition. Next is balancing growth and investment need with obligation to pay dividends. First is debt financing and external capital. Borrowing money allows company to chase growth opportunity like expansion project while preserving capacity to provide consistent returns to shareholders. Next is cash flow management. Strong and consistent cash flows allow business to fund growth strategy and still left with enough money to pay dividends. Last is dividend policies and growth expectations. Implement dividend policy that aligns both long-term growth expectation, which is growth investment, and short-term returns, which is dividend payment. Examples of companies that manage the balance of growth and investment needs with obligations to pay dividend. First company is McDonald. How capital and dividend policy are structured to achieve goals are: first, for capital, heavy investment in technology like digital ordering. For dividend policy, raise dividend annually and uses its strong cash flow to fund dividend payouts. Second is Johnson& and Johnson. For capital, a significant amount of capital is allocated to research and development for new drugs, medical technologies, and treatments. For dividend policy, ensuring sustainable dividend payouts even during heavy investment period.
Next is recommendation. The first one is capital structure, which is maintain moderate debt to equity ratio. Aon's current debt to equity ratio of 1.81 indicates a healthy balance. To optimize, Aon should aim to maintain or slightly adjust this ratio to maximize the benefit of debt while avoiding excessive financial risk. The second one is dividend policy, which is adopt a residual dividend policy. A residual dividend policy will allow Aon to give the first priority to reinvestment in high return projects and pay dividends out of residual surplus earning. For conclusion, Aon balanced growth and stability with a low debt to equity ratio and a 49% dividend payout ensures enough funds are reinvested for future projects while still rewarding shareholders. And the second one is sustainable growth and stakeholder value. Aon focused on digital transformation, infrastructure development, and sustainability strengthened its position in Malaysia's retail market. By balancing investment and dividends, Aon continued to grow while meeting shareholder expectations, offering valuable lessons for other companies aiming for long-term success.
That's all from us. Thank you for watching.